Welcome to the Fund Your Retirement podcast.
Hello, everyone, and welcome back to the Fund Your Retirement podcast. It's episode number 37. My guest today is Paul Belanger, who is clearly up for a lot of pain as he's agreed to come back for part two, as we take a deep dive into Paul's investment and financial philosophy. Hello, Paul. Welcome back.
Hi. Well, thanks for having me. It's a pleasure to be here again.
Yeah, thanks for coming back, Paul. You know, in part one, we discussed your saving and investment philosophy, and it was massively insightful. Really enjoyed it. And we did say at the end that we'd like to invite you back for part two, where we take a deep dive into more of the components of how you construct your portfolio. One of the topics being the monetary backing of gold, how gold is still important to the monetary system. And secondly, how you construct your portfolio of 65% stocks and index funds is. And just wondering if you'd like to delve a little bit deeper into how do you construct your portfolio of stocks and index funds?
Okay, sure. Well, you had asked me, I guess, before we started the interview, if we could discuss whether or not I invest in individual stocks.
Correct.
And
yeah.
the answer is at one time I did. It was not terribly successful. I mean, it wasn't a disaster either, but I reviewed a lot of literature over time. And ordinarily I take what the academics say with a grain of salt, because, I mean, after all, they're not practicing. So what do they really know? But eventually I came across a article where they were having a discussion with Ben Graham, who was the father of, value investing. Obviously a practitioner. He was very involved during the Great Depression. But I guess this was back in the 1970s, where he said that, it used to be that you'd be able to find value by just delving through balance sheets and income statements. But over time, the space had become so crowded that the efficient market hypothesis had won him over. And at first I rejected that comment out of hand. I'm like, well, how can that possibly be? But over time, I reviewed a lot of literature, and what I came to conclude was that there were a lot of very smart people with a lot of resources who are investigating balance sheets and income statements. They're taking aerial photographs of parking lots, right? They're interviewing people. They just have a tremendous amount of time and resources available to them. Some are on the buy side, some are on the sell side. So they're all competing with one another to edge each other out in terms of picking the best stocks. And what that basically leads to is the conclusion that, okay, all of the currently available information is probably reflected in the stock prices to a large extent. I mean, that doesn't include mania stocks. I mean, obviously there are, some mania stocks right now. I think Tesla might be one of them.
Yeah.
But in general, I think most stocks are priced in such a way that the only thing that really moves them either above or below market expectations in the future are the things that aren't predicted. Future events that's not really known and not really knowable. And so when you take a look at individual stocks, when you buy one, chances are you're getting a fair price most of the time. However, if you only own one stock, two stock, maybe 5 stocks, you're opening yourself up to the vagaries of the future, right? And it might push you into very high performance, and it might push you into a disaster situation. And so, a key example that I would give of that would be General Electric. So in the late 1990s, General Electric was like a one decision stock. It was the one stock that you would want to own. And in fact, if I had a time machine and I went back in time and I was only able to own one stock without knowing what the future was, it would be GE, right? Kind of similar to, I guess, how Berkshire Hathaway might be a one-stop shop stock right now. But if we take a look at what actually happened to GE over the subsequent 2 decades, it was an absolute disaster for the people that held it, right? So we had this financial, juggernaut that basically had destroyed itself from the inside. And the people that were buying it at the time could not have known that. And so I think GE is a prime example of why people should not overly commit to one stock. And in fact, I think that most people are well served by only putting at most 5% of their portfolio into a single company. And for that reason, I tend to focus on the index funds.
Yeah. So you 5% individual stocks, and then the 55-60% in index funds then?
Yes. And I focus mainly on the value funds.
Yeah.
And there's a couple of reasons for that. One reason, I alluded to, and that is that, we do have some Teslas in the world, and Apples and Facebooks and Googles. And I think, they do have a bright future, but whether or not they have as bright a future as the price is saying that they're going to have, I have some doubts about that. And so, given that I think that most stocks are fairly priced, I like to avoid the high flyers, and I buy just, the value indices. The other reason is that I did a little bit of math, and what I concluded is that for a person that's taking distributions from their stock accounts, having a steady stream of dividends paid out, and the value stocks tend to pay more in dividends than the growth stocks do. It really dampens out the effects of market volatility. So during the down years, if you're getting 50% of your income from dividends, then you're relying on lower amounts of sales of stocks that could be at a depressed price. So it really reduces the sequence of return risks by focusing on the stocks that pay out more of their income as dividends.
Yeah, okay. And I know that the next thing that we've been quite keen to share is why is gold still important part of the monetary system, which is also a big part of your portfolio.
Okay. Well, we have to go back and do a little bit of history. So I hope I don't bore people too much.
Stay with us. Stay with us.
Stay with us. Yeah, this will get good, I promise. Yeah. Okay. What I'm going to do is I'm going to share my screen. And
so I'll make you host, Paul, and then you can share screens. And anyone who is listening over the podcast, there will be the link to the video in the show notes as well. So you can just watch it by clicking on the link.
Okay, so I'm going to start with a US-centric view, and then I'll talk a little bit about the European Central Bank after we're done with this.
Yeah.
But can you see my screen here?
Yep, I can see it.
Okay. So I'm going to start off with how much gold is being held by the US Treasury. And this is a plot of the amount of gold held over time. So prior to the year 1900, you can see that the US really didn't hold much gold at all. And in fact, prior to 1873, the US was on a silver standard. So the US dollar was defined in terms of silver. So it was a certain number of grains of fine silver. And they also defined the price of gold relative to silver. So it was essentially a bimetallic system, but the dollar was defined as a certain quantity of silver. So there was a Coinage Act of 1873 that redefined the dollar, and it essentially demonetized silver. So from that point forward, the dollar was defined as a certain quantity of gold, and silver wasn't even mentioned to a great extent in that act. And it was a highly deflationary event because, remember, debt is paid back in the currency of the realm, right? And there was a lot of debt that was denominated in dollars, and now all of a sudden the definition of the dollar had changed, and it was defined in terms of gold instead of silver. And silver was abundantly available, but gold was not. So it was a very, very deflationary event. Yeah. And then we go through time, you can see that the amount of gold held by the Treasury gradually increased, as the monetary use of gold had increased in the United States. We got to the point of time of 1913, which is when the Federal Reserve was first established. And then we got to crisis period. This was in 1929 when the stock market had crashed. And when there was a banking crisis at the time, because the banks were heavily levered, and they had a lot of claims against the gold that was on storage with the banks. And people were taking their money, which was redeemable in gold at the time, going to the banks and demanding redemption. And the banks themselves were in great jeopardy of having to close their doors. In fact, quite a few of them did. And as a result of that, there were people that were ruined. You don't want to start a bank run, but you certainly don't want to be the last in line either when one starts, right? And so,
isn't it?
yeah. And so one of the first things that Franklin Roosevelt did as president was he issued an executive order creating a bank holiday. And in early 1934, there was a new Bullion Reserve Act that was enacted. And what ended up happening as a result of that act was the banking system's gold was basically taken away from them, and it was put into the treasury. And we can see here, the start of the rapid increase of gold into the U.S. Treasury. And the gold was replaced with claims on gold. So these are gold certificates. So the gold certificates for the Federal Reserve are basically encumbrances on the Treasury held gold. So the Treasury cannot sell the gold that it has because it has a liability issued against it. And the Federal Reserve itself owns the encumbrance on the gold. So it's like a lien on your house when you take out a mortgage, right? And the banking acts allowed the Federal Reserve to issue Federal Reserve notes, which are what are currently circulating as currency. And it was based upon a gold coverage clause. So depending upon how much the central bank and all the other banks had in terms of gold certificates, that limited the amount of Federal Reserve notes that they could issue. And we can see that over time, especially as the war was raging in Europe, the amount of gold being held by the Treasury increased quite a bit.
Yeah.
And a lot of the reason for this was that people were very concerned that Hitler and Germany were going to basically take over Europe and confiscate all the gold. So they sent it over the Atlantic to the Federal Reserve, for safekeeping in our banking system. And so that's largely, the reason why the amount of gold held by the Treasury increased. In addition to that, the U.S. was supplying a lot of munitions to the rest of the world and generating a lot of profit. And so the currency flow resulted in gold basically entering our banking system. So we got to a point where the war had wound down, and then we had to invent a new monetary system. And so in the Bretton Woods Agreement, all the nations agreed that the gold could stay in the U.S. Treasury and that they would use, U.S. money as basically the reserve for their own currencies, which worked okay until we got to the guns and butter period of the 60s and 70s, where the U.S. was deficit spending. So as Jacques Rueff once said, we enjoyed an exorbitant privilege and we abused that privilege. And so a lot of countries became suspicious that the U.S. wasn't going to have the gold to back the currency that we said that we were going to have. And so similarly to how there was a run on individual banks back in the 1930s, there was a run on the U.S. Treasury in the 1960s leading up to 1971. And what we can see here is that the amount of gold declined from over 600 million ounces down to where it currently stands, which is at about 260 million.
Mm-hmm.
So in 1971, this was when President Nixon issued an executive order saying, okay, we will no longer redeem our currency in gold. Okay, whereas before 1971, at least foreign entities were able to convert their currency to gold. And this stopped the flow of gold out of the U.S. Treasury. So it stabilized at about 261 million ounces. And it ushered in basically a new monetary era. Whereas before, surpluses and deficits would see a flow of gold into and out of the Treasury. After 1971, deficits and surpluses would no longer see gold leaving the Treasury, but it would see that the price of gold would change. So the monetary valuation of the gold would fluctuate with the deficits and surpluses as opposed to gold actually physically moving. Okay. Now, most people don't really appreciate that gold is still an important part of the monetary system. They think, okay, in 1971, that was basically it. We changed money and now the dollar is gold. But I don't think that the major banking interests and world interests see it that way. And so let me move to another exhibit, and I'll show you exactly what I mean. And this is directly from the US Department of Treasury's website. So it says, what are Federal Reserve notes and how are they different from United States notes? Okay, and I'll just read the key point here, which I circled, and it says, Congress has specified that a Federal Reserve Bank must hold collateral equal in value to the Federal Reserve notes that the bank receives. This collateral is chiefly gold certificates and United States securities. This provides backing for the note issue. The idea was that if the Congress dissolved the Federal Reserve System, which is a very interesting statement for the Treasury to make, right? Even hinting that Congress could decide to do that.
Yeah,
the United States would take over the notes, which are the liabilities. This would meet the requirements of Section 411, but the government would also take over the assets, which would be of equal value. Federal Reserve notes represent a first lien on all of the assets of the Federal Reserve banks and on the collateral specifically held against them. So now we have to talk a little bit about the assets and the liabilities of the Federal Reserve System. And the Federal Reserve, on a weekly basis, publishes the H4.1 report, which has a bunch of tables. The first table summarizes the assets and the liabilities. Table 7 discusses collateralization of the notes, which is another important table to recognize. But this section right here is key because when you take a look at the assets of the Federal Reserve, it consists of primarily three things. One, special drawing rights from the IMF, and that's a very, very tiny account, almost inconsequential relative to everything else. Okay. It holds a lot of loans, primarily Treasury securities, which are liabilities of the Treasury. Yeah. And then it owns the gold certificates, which are claims on the Treasury-owned gold. So if the Federal Reserve System were to be dissolved and the Treasury were to take over the liabilities and the assets of the Federal Reserve, what would happen to the main asset of the Federal Reserve, which is the Treasury securities? Well, it would essentially be annihilated, right? Because the Treasury can't count Treasury securities as its own asset because it's also its own liability. So they would essentially go away. And what would remain would be the SDR account, which is very tiny, and the gold certificate account, which right now is at a statutory price of $42.22 per ounce of gold. But when marked to market, it's actually quite substantial.
Yeah.
Right.
Yeah.
So this leads to how I personally value gold relative to the currency. And we can talk about this chart a little bit.
It's really interesting, by the way, I think you said there. So I hope the audience are enjoying it as much as I am.
Well, most people value gold based upon like technical analysis. That's what I think that's the device that a lot of people resort to, right? Because it, tells you what everyone else's intentions are with regard to, buy points and sell points. So you kind of like get the view of what other people are thinking when you take a look at technical analysis. But I like to view gold in terms of fundamental analysis from the standpoint of the banking system.
Yeah.
And this chart to me encapsulates what the fair value of gold would be from a banking perspective, using the Treasury's own admission that the gold it has as the currency in circulation serves as the first lien against the gold. We can use that to value the US dollar relative to the gold held by the Treasury. So what this chart shows you right here is since 1971, how much of a backing the gold has represented relative to the currency in circulation. And bear in mind, the currency in circulation is published by the Fed every single week, and it's been growing almost every week since 1971. So back in 1971, when Nixon closed the gold window, gold represented a backing of about 20%. So there were five units of currency in circulation for what the gold in the treasury could back it at back then. Okay. And when you think about fractional reserve banking, that represents a typical level of confidence in what a banking system would have to have on reserve. You know, if you take a look at long-term history during periods of supreme confidence in banks, the banks would be allowed to float as much currency as they could, where it would represent maybe 20, 25 times what was available on deposit, to be redeemed if necessary. During periods of suspicion, you would have a situation where the banknotes would be turned in to the point where there was almost no fractional reserve at all, and the currency that the banks would lend out would be almost 100% backed.
Yeah.
So if we take a look at what happened during the early 1970s, right, the amount of backing actually increased. So as we move from left to right, you can see that we went from 20% backing down to or up to a 62% backing in 1975. So we had about an issuance of 2 to 1 of currency relative to gold. And then in 1980, we hit a magic point right here where we actually had full backing. So, again, remember what I said about ever since 1971, gold didn't move from the treasury, but the price changed. And it was really the price of the dollar relative to gold that's been changing. And in 1980, we hit a point where gold was so valuable that the gold that was in the treasury could have fully backed the currency in circulation. And that was about the point in time when people probably could have fundamentally said, okay, well, this is about it for the move on gold. It's entirely possible that more currency is going to be printed, but gold is simply going to keep up with the currency in circulation. It's not going to become more valuable relative to the currency. Okay, but Paul Volcker at the time was head of the Federal Reserve, and he took some emergency actions in the late 70s and early 80s, and he took interest rates up to, I believe it was 15 to 18%. It was a very, very high level. And this was also the period of time when the futures market started to become active in gold and silver. And we can see that over time, because the currency was strengthening, confidence in the banking system was increasing. And this was also the period of time when the stock market was going up. And as people became more and more confident in the US and its financial system, the amount of backing actually went down simply because of the price action of gold. So as we saw gold go from, I believe it was about $850 per ounce, down to a low in 2001 of close to $250 per ounce, the amount of backing that gold had relative to the currency dropped to about 11%. So it went from full backing to 11%.
Yeah.
And that was the period of peak confidence in the US financial system. And of course, we know what happened shortly thereafter. I mean, we had the terrorist attacks of 2001. We had a bear market in stocks. The high flyers at the time started going down. Yeah. And so confidence in the US financial system started to wane. And so naturally, the price of gold went up to the point where we reached about a 50% backing in 2011. Now, this wasn't anywhere near the full backing situation that we had in 1980, but it was certainly stronger than what we saw in 1971, where we started with a 20% backing. 50% backing is actually fairly meaningful. But ever since the peak in the gold market in 2011, confidence in the U.S. system has increased. A lot of it had to do with capital flows coming into the stock market because stocks were getting more and more valuable. Bond yields were going down. Capital was flowing into the U.S. And we reached a point of stabilization at about 20% backing again, which is really where we were back in 1971.
Yeah, I see that. Yeah.
Right. So you can see that this is a valuable tool because it's a stable oscillation, and it tells you basically when the key points are when the currency is strong and the currency is weak relative to gold. So this gives you a tool that you can use to speculate on the currency.
Yeah. It's very handy, actually, isn't it? For directional bias for the US dollar. As someone who trades currencies quite a bit as well, it's it's quite an insightful tool, definitely. Yeah.
Now, bear in mind, this is a long-term valuation tool. So if you wanted to use this as a speculative tool, I think the way that you could use it is that this provides you with a fundamental that you can then combine with some kind of a technical analysis that would tell you basically which direction it's going, right? So currently we are at about let me take a look at the balance sheet now. So I summarized basically the balance sheets of the ECB and the Federal Reserve on this sheet. Okay, so let's take a look at the right-hand side. If we take a look at the assets of the Federal Reserve, it says in Table 7, that's the collateral report, that the gold certificates represent $11 billion worth of collateral. Now, again, this is at a statutory gold price of $42.22 per ounce. So we have to do a mark-to-market accounting here. So if we divide this $11 billion number by $42 per ounce, we come up with 261.4 million ounces of gold, which coincidentally is exactly the amount of gold that's held by the Treasury. So gold has been fully monetized and is fully encumbered by the monetary system. And then if we take the 261 million ounces of gold and multiply it by $1,789 per ounce, which was the market price this morning, we come up with a value of gold at $468 billion. Okay, so that's currently the mark-to-market value of the gold held by the Treasury that's encumbered by the gold certificates. Now, the Federal Reserve says that it has assets of $8.7 trillion, which means that gold as a percent of its assets represents about 5%. And keep that 5% number in your head because that'll be important when we go to the ECB balance sheet. But to me, the important ratio has to do with the physical currency in circulation. And, again, I talk about physical currency a lot because according to the Treasury statement, it's the physical Federal Reserve notes that are the first liens against the Treasury gold, not the bank balances. Now, remember, the bank balances are basically fractionally reserved in Federal Reserve notes. So the banks pay back the physical Federal Reserve notes. According to the Treasury, it's the physical Federal Reserve notes, which, by the way, can only be printed by the Bureau of Engraving and Printing, which is a division of the Treasury, not a division of the Federal Reserve. Okay. There's a reason for that. And that is that the Treasury wants to control the amount of physical Federal Reserve note or physical currency that's out there.
Yeah.
Okay. So when we take a look at the currency in circulation, it's $2.2 trillion right now. And if we take a look at the gold backing of the currency in circulation, right now, it's about 21%. So to me, that means that gold is right around the same level that it was in 1971.
Yeah.
So if you would decide that you wanted to go back in a time machine and buy gold in 1971, you should be just as happy to buy it at current levels.
Yeah, based on what we've just looked at.
Now, according to the historical record, the average has been about 25%. So if I had to take a guess right now, gold is slightly undervalued relative to the currency in circulation. But bear in mind, it's a moving target because this currency is being constantly printed, right?
Yeah.
So the price of gold is going to continue to go up as physical currency is printed.
And
But
that's what
yeah,
I was going to bring into as well, actually. I was going to ask you about the amount of money that's being printed is actually increasing as well. So that's only got to further improve the price of gold based on what we've just discussed. Is that a fair comment?
yes. So the way that I look at it, Lee, is gold right now is kind of like the bonds of old, right? Bond interest has kind of been nullified because the bond interest that most people get for holding long-term bonds is about the same as the rate of depreciation in the currency.
Yeah.
Okay. In fact, it's even less so because over the past 50 years, the rate of increase of currency in circulation has averaged 7 to 9% per year. Okay. Bond interest has only been that high in the late 70s and early 80s, right? But before that and after that, bond interest was very much lower than the rate of increase in currency in circulation. And so gold, I think, is a better holding than bonds right now. And I think it actually generates a pseudo interest. And it's very difficult to grasp why this would be. But if you consider what's happened over the past 50 years, the currency in circulation has been printed to keep up with the economy. The economy has been constantly growing. And because of increases in productivity, the CPI, or Consumer Price Index, has not increased at the same rate as the rate of increase in currency in circulation. Mm-hmm. Now, if on average, gold is going to track the increase in currency in circulation in terms of its price, and the currency in circulation is going to increase faster than the CPI increases, then the benefits of the productivity enhancements are going to partially flow towards the holders of gold.
Okay.
And that's a pseudo interest. So it's increasing your standard of living without actually having to generate taxable interest, which is what the bonds do, and it's without having to take on counterparty risk.
Yeah.
Okay. Now let's talk a little bit about what other governments are doing. Okay, so we have the ECB, which is kind of like a quasi-government, right? It's a result of cooperation between many European nations. Now,
it's a polite way of putting it.
Yeah. Well, I mean, the euro was an interesting experiment, and it was a couple decades in the making. I think part of the reason why the euro was invented had to do with a response to how the US was handling its affairs, because ever since Bretton Woods, the US has kind of held the rest of the world hostage in terms of monetary supremacy. Okay. And even in 1971, countries like France really had no options because most of the trade in the world was being transacted in dollars, and there was a lot of momentum, right? And that's a momentum that's really, really hard to undo, even if the U.S. defaults on its obligations as it did in 1971.
Yeah.
And so I think over time the euro system was planned. And these things take a long amount of time because you're talking about getting sovereign nations to cooperate with each other. But I think that this was largely in response to the dominance of the U.S. currency. And if you're going to launch a new currency that's going to compete with the dollar, you primarily need one thing. You need to be a very, very large trading bloc, because otherwise it's not going to work. Mm-hmm. And so the Eurozone became that trading bloc. And what they did that was interesting was when they created this currency, they got subscriptions from the major countries within the Eurozone that signed on to the agreement.
Yeah.
And the major countries tendered some of their gold holdings.
Okay.
So Germany turned over some of their gold. France turned over some of their gold. Italy turned over some of their gold. I mean, the price of subscription was essentially gold into the system.
Right.
And this
That's
is
interesting.
gold. Yeah, this is gold that the European Central Bank still holds.
Yeah.
And I believe that they're collateralized in the same way. I mean, there are physical banknotes that are floated out there.
Mm.
But unlike the US, what the ECB does is they flaunt the amount of gold that they have. And how do they flaunt it? They market to market, meaning every time that they issue a report, the gold that they have will reflect the full market value. So currently, if you take a look at the ECB balance sheet, they're saying that the gold that they have on deposit is worth 518 billion euro. Okay, and that's out of a total asset base of 8.4 trillion euro. Okay, now similar to how the Fed works, the ECB holds a lot of sovereign debt, right, as assets, and it holds gold. And the gold represents about 6% of its total assets. Now you can compare that to what the Fed has, right?
Just above
5%. So it's a very similar number.
Yeah.
But then let's go to the liabilities, right? The Eurozone right now has about 1.5 trillion euro worth of banknotes floating in circulation. If we compare the amount of gold that's on deposit with the ECB, that works out to be about 35%, or more than 1/3 of the amount of euro banknotes in circulation.
Right.
So what does that tell us? It basically tells us that the euro as a currency is stronger in collateral than the dollar right now, to a large extent.
Yeah.
And so if I were to hold a currency instead of gold, I would be holding the euro right now instead of the US dollar. And that's basically what this tells me on a fundamental basis.
Yeah. Over the long term, taking a long-term sort of view.
Over the long term, that's right.
Yeah. Yeah. When you say long-term, how sort of long are we talking? What's the time frame?
Well, let's go back to this exhibit and take a look at how the value of gold changed relative to the dollar. So we see decade-long periods of strengthening, decade-long periods of weakening. In fact, the weakening that happened in the US happened over a 2-decade period. And then we had a decade of strengthening, and we've had a decade of weakening. So we're talking about many years here.
Yeah. Yeah. The ultimate long-term sort of projection, isn't it? It's like looking out into the future 10, 20 years, isn't it? And making sure that the directional bias is in your favor.
Correct.
Does the current rate of money printing concern you, not just by the US government, but the collective central banks around the world, the amount of money printing that's going on? Do you think that's an unforeseen situation that isn't reflected in the chart in front of us at the moment?
Well, it would bother me, I suppose, if I was a lender of currency. Okay. But I'm not. So, I mean, I have cash reserves for, expenses that are within a year.
Yeah. Okay.
But I don't hold cash reserves to a point where it's more than 1% or 2% of my total portfolio.
Yeah, it makes sense. Yeah.
Right. And a lot of the cash savings that I have are in inflation index bonds. So these would be what we call I-series savings bonds.
Do you think that we are experimenting with a new type of monetary system at the moment with the modern monetary theory?
I do. Let me stop sharing. And, okay. We back?
Yep, we are back.
Okay.
Tell you what, actually, that's better. I can see you now. It was hard to see you and watch the screen, which was fascinating.
Yeah, that's right. That's right.
It's nice to have you back there on the screen with me.
Yeah, it's a lot better having a picture, to back the discussion that we just had. But I do think that we're entering a new type of monetary era. Politicians, as we've discussed, always have as their goal to be reelected, and they like to give out goodies. right? The more bread and circuses that they can create, the more popular they're likely to be with the greatest number of people. And that always leads to monetary mischief. Right? We saw in the late 1970s and early 1980s here that it was a very unpopular thing to do to jack up interest rates. People did not like it at all. Right? But that was the financially responsible thing to do. But I think we're in an era right now where the politicians largely will do whatever they think that they need to do to keep the people happy, to keep stock prices elevated. I mean, what was it that Mario Draghi said back in 2000? I think it was 2009. We'll do whatever it takes.
We will do whatever it takes.
We'll do whatever it takes.
Whatever it takes. That's the mantra, isn't it? Still.
Exactly. And, ever since the crisis of 2008 and 2009, I think the politicians have learned the wrong lesson. They have been creating money with impunity. And in fact, they've been rewarded for creating money. Ever since 2009, the US stock market has been rocketing up, right? Interest rates have been coming down. People have been generally doing fairly well despite a lot of the political backlash that happens for this reason or for that reason. But, in general, people have been benefiting but not having to pay for the largesse. And so the politicians have come to believe that this can go on forever. And right now they found a bunch of academics who will give them theoretical backing for that view in the form of modern monetary theory. Now, I've read a lot of modern monetary theory, and at first I found it actually very compelling. Because it talked about public balance sheets and private sector balance sheets. It talked about taxes and how taxes could be used as a tool to, control the rate of price appreciation in goods and services. But I got to what I thought was the key flawed premise, which was they said that if the government or the public sector didn't run a deficit, then there would be no debt, and hence the private sector could have no savings, which is complete and utter madness and obviously unsustainable. Because when you think about the implications of that, it's completely immoral, because government debt is basically, an encumbrance or it's bringing future generations into indentured servitude. It's pulling future consumption or future prosperity into the present. And so modern monetary theory is basically telling the politicians, go ahead, print all you want, create all the debt you want. It will generate prosperity because we'll have all this savings. But the reality of the situation is that, the savings is going to be backed by a smaller and smaller amount of productive labor. So far, they're getting away with it, right? Because, the Cantillon effect says that the people who are getting the money first are basically the ones that are, the wealthy people. They are taking the money and investing it in stocks, right? They're investing it in real estate. They're putting the money into bonds. I don't think that's very smart, but the money's got to flow somewhere. And they're not using it to buy consumption goods as much as, let's say, the lower echelons of people would, had the money been given to the people who really needed it. I mean, there's only so many cars you can buy. There's only so many houses you can buy. There's only so many yachts you can buy. So, these things that the wealthy people have been buying with the money that they've gotten first are not really reflected in the CPI statistics. So even though we're seeing the effects of inflation in financial assets, we're not really seeing it, or at least until this year, we haven't really been seeing it in the general cost of goods and services, because the money hasn't been flowing to the people who spend it on goods and services, right?
Do you think that the money hadn't been flowing up until we experienced COVID, when COVID hit, locked down the economy, and the governments collectively, I'm not sure about Europe, I definitely know of the UK and also the US. They paid people to stay at home basically, and without the ability to spend that money, we're now seeing the results of that money coming back into the system. Do you think that we then cross the Rubicon in how they've crossed the line of being able to give the people direct money, direct transfer payments?
Well, I don't think the transfer payments were that big.
Okay.
I mean, in the grand scheme of things, it's not like a permanent money flow. At least not. It hasn't been set up as a permanent money flow yet, right? I mean, we've had single payments of a few $1,000s per family.
Yeah.
And yeah, it's gonna help families out, but it's not really gonna create general prosperity for everyone, right? It's not gonna create a situation where people are euphorically spending their money, right? So I think it's going to take time. I mean, we have a very, very large amount of pent up wealth stored in stocks and bonds and businesses, and eventually it'll probably work its way into the general economy. But as I said, there's only so many goods and services that wealthy people will buy, and so it will probably take quite a bit of time.
Yeah.
Now, there may be there may be a temptation on the part of politicians to create a basic income for people. I mean, I believe that might be coming.
UBI.
Universal basic income. And if it's high enough, I think that definitely could create a lot of pressure on the prices of goods and services. Right.
Yeah.
Now, to me though, the wild card, what would create rampant price inflation really would have more to do with a confidence event than it would do with spending on goods and services.
Yeah.
Right. So far, there's a lot of confidence in the currencies, more so than I think is warranted.
Yeah.
And if people start to lose confidence in the money the money supply, and its velocity starts increasing quite a bit, I think we could really see prices of goods and services increase, relatively quickly.
Yeah.
And I'm not talking about what we're seeing right now in the price of plywood or ammonia-based fertilizers or tires or things
Housing
like
products, insulation, things like that. Yeah.
Yeah, I mean, we're not to a point yet where people are buying things for the sake of storing them in their garage.
Yeah, because they're worried about
value.
Yeah, they're worried about tomorrow or next week, the future type thing. Yeah,
right.
It's
we're not Venezuela yet.
No. And largely the confidence that people have within their own currency is to the degree what maintains the value of the currency. If people lose confidence in it, then it has no value. And I think the whole thing about UBI is providing people still believe in it and have confidence in the currency. If they get an extra $1,000 a month, then do you think that you could still see the stock market rise if they did sort of bring out UBI?
Well, I think that we're going to see the stock market rise regardless. And the reason is I took a look at stocks and gold over the past 50 years, and I noticed something very curious. And that is that both tend to track currency in circulation. So as the currency in circulation has gone up, both gold and stocks, at least long term, have tracked it. Now, what's interesting to me is that they tend to track it at different rates. So sometimes stocks take the lead and gold turns out to be soft.
Yeah.
Other times gold takes the lead and stocks turn out to be soft. But long term, the rate of appreciation of both, and I'm excluding dividends, by the way, the rate of appreciation of both has been largely a currency dominant effect.
Yeah.
Right? So yeah, I think we may experience a period of weakness in stocks. It's entirely possible. We've had it before, but the long-term trend is up.
Yeah.
And it's largely currency debasement that's causing that, and not actual growth in value.
No, I think to encapsulate what you've kind of covered, which has been absolutely brilliant, whether we're money printing or not, gold is a perfect hedge against the future, based on the information that we've shared so far in this episode. If we are going to carry on money printing, which seems to be the situation, gold is going to rise anyway.
I think long term, the answer is yes. But as we've seen, the valuation can change over decade-long periods.
Yeah.
Right. So I guess my advice to the person who says, well, I really don't know, but I want to protect myself, is both gold and stocks do the same thing. They protect you against currency debasement, but they do it at different rates and at different times. And it seems to me that what has worked the best over the past 50 years has been about 1/3 gold and 2/3 stock.
Yeah.
Right. And that way, regardless of the direction that it goes, you'll largely protect yourself from currency debasement. And in fact, you'll actually benefit from it, because the currency debasement is faster than the rate of productivity or the rate of CPI escalation.
Yeah.
But if you want to do a little bit of technical analysis or throw a little bit more fundamental analysis into it, you might be able to do a little bit better.
Yeah.
By adjusting the mix.
Yeah. No, it's fantastic. Absolutely brilliant. Well, thank you very much for your sharing this with us, Paul. Absolutely loved it. I'm sure the audience will have done it as well. I was just like you to share a little bit about where people can follow you. Where can they find you? Evidence-basedwealth.com, and share a little bit more about yourself and your social media channels.
Yeah, well, I have a free YouTube site if you like videos, and I have a free website. Both are evidence-based wealth, and the website has written articles, which I happen to prefer. A lot of people prefer videos, so if you want the videos, you can go there. But I have links on my website to video playlists that I consider to be very important, and a lot of the fundamental information that I presented here is encapsulated in those playlists. So I would encourage people, if they want to know more, to go check those out.
Yeah, perfect. Well, thank you very much for your time. Really appreciate it, Paul.
Sure. Well, thank you for having me back. I enjoyed it.
Yeah, cheers. Thanks.
I hope you enjoyed the video, and if you haven't subscribed yet, go ahead and subscribe to our YouTube channel. And you don't have to stop there either. We have more videos on the screen for you and lots more insightful content on our channel and our website, fundyourretirement.com. I want to thank you very much for your time, and I'll see you in the next video. Bye for now.